Welcome to another edition of Wealth Quest. I'm Samantha in our monthly series called Wealth Quest Graph Focus. We look at some of the most thought-provoking graphs we've seen during the month. We'll also be discussing these and taking a look at the investment implications that they hold. Welcome to Wealth Quest Graph Focus. Joining me at the desk, Roland Rousseau Equity Strategist from Absa Capital, Cobie Legrange, strategist at Clucasgray Investment Managers. Cobie, you're going to start us off on this, I think. So go take it away.
No, I think one of the big issues is if you read the media, they'll tell you how fantastic emerging markets have been as an investment destination. They'll tell you how fantastic your money is done in emerging markets, and that more and more people in the Western world should actually have put money into the emerging markets because you would have made so much more money. So I've actually drawn two graphs that I'd like to show around kind of the BRICS nations. Now remember, those include Brazil, Russia, India, China, and then South Africa as well. So have a look on your screen right now, and you'll see the performance. I've rebased all of these to 100, and you'll see the performance of those 5 markets that I spoke about just now. And the two, and this is now in local currency terms, that you've actually made money is India and South Africa. This now, the investment date here is basically just before the financial crisis, and you can see there the financial crisis happens, and you can see India and South Africa actually doing quite well. The rest of them, which really is the rest of the BRICS, which excludes South Africa and India, you actually haven't done that well. And just to kind of add more clarity to the example that I'm using over here, I rebase these to dollars in this graph that you see over here. And this basically means this now looks from a dollar perspective. You're an American fund manager, you've placed money in emerging markets, and 5 years on, where are you? Have you made any money? And here you can see, in South Africa and India, you've basically stayed just on an even keel. You've probably made yourself about 4-5% per annum, but that's about all you've made. In the rest of them, you've lost money. And that's quite interesting. So BRICS aren't all, it seems, at the end of the day.
Yeah. And China, of course, Russia have had a pretty shocking year to date. So let's get into your graphs because you're looking at the developed world for us, Roland.
Yeah, we found these graphs. This is part of Barclays Global Strategy team, and it just highlights for you the US versus the European situation. And in the graph with the dark blue line, you will see the relative valuation in terms of price to book between the US and Europe, and we are at a multi-decade low at the moment where the dark blue line is sort of bottoming. That means that the European stocks are much cheaper relative to American stocks than they were a few years ago, and certainly than they've been historically. So this is clearly a sign that you want to try and pick some shares in Europe rather than in the US. And the grey line is basically the relative return, and that scale is just inverted, which means that when it goes down that grey line, it means that the US is underperforming the European markets, which is what we're probably anticipating here, because you can see that the grey line always tries to catch up with the dark blue line. So it's certainly looking like we are at a reversal point where you don't want to have your money all in the US at the moment, and you want to start switching that into European stocks. And then my second graph is quite similar in the sense of looking at the earnings in Europe. And the light blue line there is currently lead. It is the leading indicator from the OECD. And all it is it's saying that industrial production is quite a good predictor of earnings growth. And we can see that the industrial production has picked up sharply in Europe, but the earnings growth has not yet picked up. So we can expect stronger earnings from Europe. And in the previous graph you saw relative to the US, it looks like a much more attractive investment destination.
So we're looking at Europe versus the US, with euros coming out on top, and we've seen a sell-off in emerging markets, specifically, of course, as I was saying, China, Russia, and certainly not South Africa this year. Put this into a basket. What are people thinking about where they should invest their money going forward, developing versus the developed world?
Well, I think the first thing is, 3 years ago, if you spoke to the investment community, they would have said to you, I'm quite happy to leave my money in emerging markets because I think there's growth, there's earnings growth, and I feel relatively safer in emerging markets than I am feeling with that asset allocation that I have in developed markets or big Western economies. And then we've gone through the whole sovereign crisis, specifically in Europe, and we're starting to see on the back end of that, we're starting to see kind of those early blossoms, so to speak. So we've spoken about early shoots, but we're starting to see early blossoms. We're starting to see earnings starting to come back into the equation. And as those earnings come back into the equation, that'll slowly start driving markets back up again. And I think in 10 years' time, people would be looking at Europe and America, quite frankly, and say, I can't believe we didn't get involved in these markets earlier. Hence, again, it's an early adopter issue. Very few people are early adopters in these markets. They much rather wait till later on in the cycle before they actually become involved.
But with people having been burnt, as you say, in dollar terms from the emerging market story, do you think that now is perhaps also a good time to be buying some of those markets?
Well, the big driver that we're certainly focusing on, and I guess everyone else is the Fed taper, because that is the whole risk on, risk off situation. Emerging markets versus developed markets, and everyone's now saying it's been postponed, so it's going out till March next year. And if the Fed starts tightening in March, that's when you're going to start seeing emerging markets taking strain, and you want to go back into quality or hard asset or hard currency kind of markets. So depends heavily on the Fed's call at the moment.
Mm-hmm. You see, I mean, much later in the cycle, you're probably going to start finding, and you're already starting to see it happening, but you're probably going to see the full effect of that, but that's demand pull for resources. Because as these earnings in Europe start turning, and in the US, at some point they start needing commodities again. And then you start getting that demand pull for commodities. That's a very, very good for emerging markets. And then you start seeing resources detaching themselves from financials and industrials, not only here, but across the emerging market set. But that's probably out as far as decision making is concerned relative to what the situation that we're sitting on at the moment.
Yeah, it'll be interesting to see what the pullback in capex from all the major miners at this point in time means for them further down in the cycle. But that being said, taking you through my graph for today, looking at Glencore Xstrata, because that's a new listing here on the Johannesburg Stock Exchange, makes it the third largest listed stock on the JSE. And just looking at the composition when it comes to key earnings drivers for Glencore versus BHP Billiton, the world's largest miner, what really differentiates Glencore from BHP is the large copper component, 30% of earnings coming through from copper. You've also, of course, got metals coming through there, like BHP Billiton, but marketing, the trading side of their business, makes up just over a third of their overall earnings, that EBIT level there. So you're looking at that, really what differentiates it from the likes of BHP Billiton. And if you look at BHP Billiton, 52% of their earnings coming from iron ore. So many saying they like Glencore because they're concerned around the fact that the iron ore price is going to come back from these levels. Just looking at the other two big miners there, Rio Tinto, of course, massively skewed towards iron ore. You're looking at 89% of their earnings coming through from that. They've also got a small element of precious metals in there, but aluminium, copper, mainly an iron ore play there. Anglo American, of course, also got iron ore, 48%, got coal, copper, nickel, diamonds, and of course Amplats, which isn't coming through with earnings at this point in time, but that hopefully will change. Just moving on to what they're spending money on, these big miners, you also see the differences coming through there, the likes of Glencore Xstrata, capex coming through, major spend on copper and major spend on oil, in fact. And then of course you look at that relative to what the other miners are spending it on, and you see quite a large divergence. I mean, iron ore, Rio Tinto, of course, with that being its major staple, spending a lot of money in that part. Many concerned about the fact that if you look at BHP Billiton and Anglo American, they're also spending a lot of money on expanding their iron ore capacity. So that's the big concern. That's why people like the less risky play in Glencore rounding that. And then, of course, petroleum is also a big play when you're looking at BHP Billiton. What is, of course, interesting is the trading margins you're seeing in the marketing trading side of their business. Now, analysts have said that these margins have, in fact, been falling since 2007. It is a bit of a bumpy ride. But on the one hand, you see it protects against the volatility in commodity prices. On the other hand, we know that in this environment right now, we are seeing a pullback in demand for commodities. Trading margins have been falling back. So putting this all together, and of course there's lots of debate out there in the market. Still, analysts got to look at coverage of the stock specifically. But if you're looking at some analysts saying that the forward multiple on the Glencore stock, which is sitting at a 2013 P multiple of almost 19, is a little bit too frothy at this point in time, because it's pricing in too much of a recovery in other commodity prices, and of course discounting for the iron ore exposure overall. Many saying it's a little bit too expensive. Let's see where the stock trades.
I mean, I think one of the things that come to mind, Samantha, with the whole Glencore type business, is that they're not a darling of the JSE yet. Yes, they're a large capper. They're certainly in the top 5 as far as their capitalization is concerned, but they don't have a track record here in South Africa as far as a listed entity is concerned. And often what happens is analysts would sit and look at the business and say, listen, we'll follow it, and we're going to put in recommendations, and we'll put it on the radar screen relative to everything else. But remember that BHP Billiton and Anglo American has a long history on the JSE.
And Anglo American specifically, of course.
Yeah, absolutely. And you have to take that into consideration, obviously, before you start looking at buying a business such as Glencore. That is unfortunately how the market works. They want to see a track record. And I mean, if you look at the global track record for Glencore, again, as a listed entity, has been enlisted not for an extended period of time, like many of these other larger type mining organizations.
And of course, I mean, Glencore Xstrata hasn't been listed for a long time. I mean, they only had the merger with Xstrata a few years ago, and then they only listed Glencore, that is, back in 2011. So it used to be known as a mining company that wasn't transparent because of the fact that they weren't public.
Look, what's happening is that the fact that they're listing in South Africa, they're not raising any new capital, so it's just another market that it is becoming part of the benchmark. What it does do is it allows fund managers in South Africa to have another rand hedge kind of play here, which is quite important. And our industrial sector in the market is so large now, so it's quite welcome from a portfolio construction perspective, never mind from a valuation perspective or from a company perspective, but just you've got another lever you can pull when you're building your portfolio in terms of managing rand exposures with this kind of more diversified from a you know, I see this more as a fund manager where you've got that kind of additional revenue from managing money, or in this case managing commodities, that provides people with a smoother ride, as you mentioned, through cycles.
If it is included in the index overall, and the consensus, of course, is that it ultimately will have to be, your thoughts on how that could influence the index, the ALSI overall, in terms of being, of course, more weighted towards resources, essentially?
Well, remember that was the debate probably about a decade ago in South Africa, that you needed something away from the all-share index in order to make sure that it wasn't so heavily reliant or heavily weighted towards commodities. And that's where the shareholder-weighted index obviously came in. So I would probably argue, and I mean, Roland is really the guy that needs to answer this question because he sits on the FTSE JSE committee as far as indexing is concerned. But I would probably argue that in a SWEX, Glencore would have a far lower weighting than it would, for instance, have in the all-share index because of that shareholder weighting component.
Yeah. So quickly from you, Roland.
Yeah, we must understand that the amount that will go into the index is only the amount that is locally available. So the size of this company is huge, but it's only going to be a very small component of the index if it goes in.